Most investors are scared of the same thing. What if I invest and then the market crashes tomorrow? I mean, just imagine for a second investing moments before the dot-com crash, or at the peak of the Japanese bubble, or how about just before the Great Depression? Ben Carlson is the author of popular investing blog A Wealth of Common Sense and director of institutional asset management at Ritholtz Wealth Management. In his new book, Risk and Reward, he looks at the history of the biggest market crashes and what they can teach us about investing when the future feels uncertain. As you probably noticed, I injured myself recently, which meant that I couldn't travel down to London to make a recent recording batch for the podcast. So we reached out to Toby Newbat last minute and asked him could he do us a favour and step in for me, and he kindly agreed to be the co-host for 4 episodes. So for the next 4 episodes, I won't be in them. I'm going to leave you in the very capable hands of Toby and Tamaine, and I'll just pass over to them now.
Welcome to Making Money Podcast. Ben Carlson, author of the famous blog Wealth of Common Sense, and also his new book, which is directly behind him. There's actually 2 copies in this room already. One I'm looking at and one's already in my bag. That was a great book, by the way. I wanted to start kicking off right at the hot topic of the moment, which is pretty much that stock markets have been close to all-time highs or hitting new all-time highs very often. Lots of investors here, certainly in my channel, in the comment section, are all very, very nervous. If someone's coming to you right now, whether they're clients or other people talking about markets at all-time highs, what would your response be to them generally?
It's understandable that people are nervous because it's like one of those all-time highs is going to be the one, right? Before there's a crash or something bad that's going to happen. And I think that's what makes people nervous. The crazy thing is, if you look at the data, investing at all-time highs is actually better than investing on any other days. So like the average returns from investing at just all-time highs is actually slightly higher going out 1, 3, and 5 years than just pick any other random day outside of all-time highs. Now, the thing is, the stock market has been booming of late, though. So it's understandable that people are nervous, like what comes next. So I guess what I would tell them is now is a great time to try to reassess your risk profile, right? Am I taking too much risk? Am I nervous? Like, am I okay holding the amount of stocks that I hold right now? Would I be okay holding them in a bear market too?
Yeah.
And I think that's what, you don't want to reassess once stocks have already gone down. Then it's too late. So now I think you go, okay, is my allocation of stocks too high? Do I need to pull it back a little bit? I think that's the conversation people need to have these days.
Yeah. And do you think it's the same sort of question? So we get a lot of new investors. So maybe touch on this a bit later, but in the UK, there's a lot less direct investment in the stock market. Most people have got a pension, but a lot less people are involved in the stock market. If someone asks you again, is this a good time to start investing? Would your answer be a similar thing as well?
I think my answer would be a lot of it depends on your time horizon. And if you're a new investor and you're a younger investor and you have many, many years and decades ahead of you, then yeah, I think it's a great time to invest because you have time behind your, it's the wind at your sail.
Yeah.
Right. You have a lot of time ahead of you. If you need to spend the money in the next couple of years, maybe the stock market is not the right place for you. So I do think that risk means different things to different people at different points of their life. Like if you're going to be putting money in out of every paycheck, you get paid every 2 weeks and you're going to put a little bit of that in the stock market, then you shouldn't be that nervous about down markets. It should be welcomed in some ways because you're going to be buying at lower prices. And I think that's the kind of mindset versus someone who's a retiree who has no income coming in and they're just relying on the stock market or their investments to fund their portfolio. Then they have to be a little more nervous about those bear markets.
How unusual are all-time highs? Or usual?
All right, so I looked at this in the US going back to 1950, and it's something like 7% of all trading days hit an all-time high. So that might seem high to some people, low to others. So I guess the thing is if you flip that and say, well, 93% of the time we're not at all-time highs, right? Most of the time you're in some sort of state of drawdown. Even right now, the US stock market is like 2% from all-time highs, right? It's fallen a little bit. So it's not like it happens every single day during a bull market. And I guess the point is over your investing life cycle, your horizon, if you're invested for many, many years, all-time highs are a perfectly normal part of investing. It is just like, oh man, one of them is going to be like the peak, right? Before the 2008 crash or before the dot-com bubble burst, like one of them is going to be like, and that's what makes people nervous. And I think a lot of people have this mentality that when I put money in, I'm going to jinx it and the stock market is going to fall, right? Everyone has that in the back of their head going, oh my gosh. So, I mean, you do have to have a plan for it. You can't just hope that the market keeps going up all the time. I think the point is you have to have a plan for investing when the market goes down too, and how to deal with it. Because volatility is like the price of admission in the stock market. You can't get rid of it.
It's interesting. Obviously, in the book, you talk a lot about market timing and timing the market. It's a phrase we all say. Like I've said on my channel numerous times, but I still get people commenting things like, "I'm just going to hold cash on the sidelines until we dip. Oh, it's all-time highs, or we're close to all-time highs. Therefore, I'm not going to invest." What would you say to those people who just are just convinced that they can time the market?
It's really seductive, and it seems like, why shouldn't I be able to do this? I'll just take my money out. I'll sit in the safety of cash, and then when the dust settles after the stock market falls, then I'll put it back in. It sounds so easy. And the problem is that you have to be right twice. You have to not only get out, like getting out is easy. So there's this old like Roman army thing that says that action removes fear, right? So if you're scared of the stock market right now, doing something, it removes that fear. Like, I'm just going to hit the sell button, and then I'll figure the rest out later. And the problem is that's the easy part. The first part is always the easiest, hitting the sell button. The hard part is, when do you get back in? And you could say, well, I'm going to get back in when the stock market falls 20%. And that sounds great. But what happens if in the meantime the stock market rises 50% from there? Do you go, oh shoot, am I going to wait till it gets all the way back to this point and then invest? Or am I going to like chase stocks higher? And that's where the psychology of it can really play head games with you. And the other part is, let's say you time it perfectly and the stock market does fall like 10% immediately. You sold, the stock market falls 10%. Oh my gosh, I'm a king, right?
Yeah.
I showed the market gods. Then you probably go to yourself, wait a minute, but what if the market falls even further? And then like cash becomes this addiction, and you're like, you can't force yourself to put it back in. So that's the hard part, is the psychology behind it, that it's always something where the market can play games with you. And it's really difficult to do. And even if you do get it right once, I sold and then I put money back in and it worked out. I've never met anyone who can do that consistently. So you do it right, you do it once, and it's almost the worst thing that could happen to you, because then you think, I can do it again. And it's really, really hard to do. It's basically impossible.
To illustrate that point, you told a story about a colleague who did time the market right, but actually ended up worse off afterwards. Can you explain to us what happened?
Yeah, I had someone who in 2008 got out in like September, right? And just before all the Lehman Brothers stuff happened and AIG and all the banks around the world are failing, and the stock market fell a further 40% or something. And she felt like a genius. She was walking around the office with like her chest puffed out, like, look at me, like I did it. And then she slowly but surely got back into the market. And then a couple of years later, there was all this stuff with the Greek debt crisis, right? And European debt crisis, and people were really worried about that. Remember, people were concerned the European Union is going to break up, and like the euro is going under, all this stuff. So she does it again. And we had a little bit of a pullback, but then the market kept going higher and kept going higher, and she got left behind. And then at that point, she's kind of thinking, oh my gosh, what did I do? I don't know what to do anymore. And we had this with a ton of clients in the early 2010s, where like 2015, people would come to us and say, I've been sitting in cash since 2008 and I'm terrified. I don't know what to do. I'm paralyzed. Help me and put this money to work, because I can't force myself, because I missed out on this huge snapback bull market rally. And I've just been waiting for another crash and waiting, and it hasn't come. And that's the hard part about market timing.
Just on a side note, do you think that, I guess one thing, firstly, do you think we're always going to keep doing this as humans? And secondly, I guess, do you have clients that call you up with that same sentiment, that maybe have got a lot of their portfolio in cash or something, or they've, again, paralyzed themselves?
I do think it is just human nature in a lot of ways. I think people can get better at this. I think there is something to it where some people just have to, like, there's this idea that you should stand on the shoulders of giants and learn from the mistakes of those who came before you, right? Some people have the ability to do that. Other people have to touch the hot stove first, right? They have to do it themselves. I have a financial advisor friend who says he'll have people come to him and say, I want to be a client of yours. Here's, what I do. Here's how I do it. And he'll say, you're not ready for me yet. Go back and make some more mistakes. Come back to me in 3 or 4 years when I think you're ready. So I think some people just have to go through this themselves. They have to like pay their tuition to the market gods and test it out for themselves to see. Because it's funny, a lot of people understand like there is no like really holy grail, like there's no perfect way to invest that, like, but everyone has that little voice in the back of their head that kind of goes, yeah, but what if there is for me? Like, what if I find that secret key to the secret door or whatever it is? And so I think some people just need to figure it out. But you're right. The human nature element is that's the one constant across every market environment, every person, and that piece of it is never going away.
I know you probably touched on this briefly earlier, but you did write a blog post about what if you only invested at market peaks. I believe it's like one of your most popular ones, and you had this character Bob. Do you want to just go through that briefly for everyone and explain what you were trying to explore in that post?
Yeah, it's funny. I wrote that over a decade ago.
Yeah.
And the reason I wrote it is because of your initial question about all-time highs. It was, the market peaked in 2007 before the great financial crisis. And we had the huge 2008 financial crisis. And then it took until 2013 for new all-time highs again. So it was a really long time between all-time highs. And we hit all-time highs again, and everyone said, oh my gosh, I remember what happened last time. Is it going to happen again? Are we going to run off the cliff, Wile E. Coyote style, and just fall? And so I said, okay, let's put up a scenario here where what if you had the worst luck in the world, and all you did was invest at all-time highs? You saved money in your bank account, and you hoarded cash, and you put your money in right before an all-time high, and then you had a huge crash. So I looked at, this guy invested over 40 years. He invested before 4 or 5 of the biggest crashes in that time, right? He lost 50% of his money in the 70s, and he had the 1987 crash and the dot-com bubble and the 2008 crash, all these times. But his one saving grace was that once he put it in, he kept his money in, right? And when I ran the numbers, I didn't know what it was going to look like. I was just curious. And the numbers, I'm like, wow, these are way better than I thought they would be. And so I sent them off to one of my colleagues, Nick Majuli. He writes at Dollars and Data. And he says, no, these are right. You did it correctly. And it's better than you think. And we both kind of went, interesting. And the reason that it worked is because he had a long time horizon with the money that he kept in the market, right? He made terrible timing decisions on his purchases, but he kept the money compounding in the market. He didn't interrupt it. And that was his saving grace. And I think the numbers, he still got like 8% returns per year and ended up a millionaire or something. And that story really resonated. It was actually kind of the inspiration for the book.
Yeah.
Because I also had a lot of people saying, okay, that's fine. Bob did this in the United States, but what if he did it in another country that didn't fare so well? So I had a lot of pushback. And I said, all right, fine, I'm going to write a book that's going to kind of go through all the exceptions and push back to the long-term trends that I espouse.
This ad's brought to you by Hiscox, so I'm not hosting the episode because unfortunately I can't. And this all really started with something that I was really excited about. This year I made myself a promise to go on more holidays as I tend to just overwork. So last month I went to Bali with some mates. On the flight I was buzzing, 10 days in the sun, but then life happened. On day 3 I had a crash with a car. I'll save you the details, but my arms were flapping around in a way that you really don't want them to. Fast forward to today, and I've had 2 sets of surgeries on my broken arms. Looking after myself has been a bit of a nightmare, and I can't really work that much. It turns out you kind of need your arms. It's the best reminder I've ever had of why the right business insurance is important. So I'm really happy that this episode is sponsored by Hiscox. They can protect you and your business for things like personal accident, which covers you in case an accident means you're unable to work. Plus it can help cover medical expenses and physiotherapy to help with recovery. They also do professional indemnity, employer's liability, public liability, business contents. They can cover your business for a lot of things that can go wrong. I couldn't make it to the last podcast recording, but it could have been even worse. If you're running a small business, then don't leave it until it's too late. Check out Hiscox and get properly covered. They're flexible and they're reasonable. There's a QR code on screen for you if you want to check that out, or there's a link in the description. Protection is subject to already holding a relevant Hiscox policy and to policy eligibility terms and conditions.
Yeah, it was interesting. Actually, you mentioned Nick. He also wrote a really interesting blog post. I've covered it twice in my videos, but it was exactly. It's even God can't beat DCA. He did a similar setup, basically saying this person hoards cash, only invests in market bottoms, and basically he doesn't even come. It's not a huge difference, but the DCA person basically beats him, just ignoring all the market noise with no perfect timing, and even the perfect timer doesn't really come out that much better anyway. It's so weird, isn't it? You wouldn't expect that at all, but it's weird how markets work.
No, and I looked at this too, and I said,
Sorry, we just got to clarify for the audience what DCA is, dollar cost averaging.
Sorry, dollar cost averaging. Yeah, that's basically putting money in regularly. Yeah, so if we get too jargony, we always use this button because we like to try and keep a very broad audience. So if I get too nerdy,
use jargon, hit the button for me too. I actually looked at this thing and I said, well, what if Bob would have bought at the bottom of the bear markets instead of the tops? And then I compared that to the dollar cost averaging, right? And actually the dollar cost averaging beat if he would have just hoarded all his money and put it in the bottom.
Yeah.
So the point is, most regular people put their money in on a periodic basis because that's when they get paid.
Mm-hmm.
So it's not like you're trying to time the market or something. You know, some people sure have a lump sum because of an inheritance or a bonus or something, but most people, the majority of people, get paid. They take money out of that paycheck, they put it into their retirement plan or their brokerage account, and they invest it every week or 2 weeks or month, right? Right. And the great thing about that is that you're diversifying your entry points into the market, right? Sometimes, sure, you're going to buy when stocks are overvalued or stocks are too high. Other times you're going to buy when stocks are too low. Most of the time you're buying when it's sort of in some middle phase where it's not too high, it's not too low. And I think that's the beauty of dollar cost averaging, that it takes away a lot of the guessing game of, oh, geez, should I put it in here or should I not? And that's why I think most people are better off just having these things happen automatically and not thinking about them.
Yeah.
I think a lot of people like to point to Japan as proof that like a downturn can last for decades. What do you think most people take from the Japan example, and what should they take, and how should they look at it?
So this was the biggest pushback for me on the Bob story, is everyone kept saying, okay, fine, that was the US, now show Japan. Look what happened in Japan. Japan topped in 1990. They didn't hit new all-time highs again until 2024, I think, right? You not only had a lost decade, you had like a lost 3 decades if you put money in at the top there. And what I wanted to show in the book is that the long term, the really long term in Japan, it actually has been okay. If you look at the last 50 years in Japan, the returns are like 9% per year. Mm-hmm. It's just that they had such a huge asset bubble in the 1980s when everyone thought Japan was going to take over the world, right? Japan's going to be the biggest economy. At one point, the Japanese stock market was the largest one in the world. Like the US is that now, but Japan in 1989 had the biggest share of global stock market. They were 45%. They went all the way from 45% of the global stock market down to 5%. And the point is that they compressed their returns in such a short period of time. In the 1970s and 1980s, the Japanese stock market was up more than 20% per year. And so to get kind of the long-term average of 9%, the returns had to be bad going thereafter. And I personally think, and I kind of make the case in the book, that Japan is the biggest asset bubble in history. Mm-hmm. It wasn't just the stock market, it was the real estate market, and people kind of lost their heads there. It's kind of funny, they haven't really had any bubbles like that since, anything even approaching that. And the point was just that there's mean reversion. So if you have really above average returns for an extended period of time, you have to have below average returns following that to sort of even it out. And that's what happened in Japan.
It was great because obviously you dedicate a chapter in the book to this, and I remember you saying one of the stats are really interesting. Was it the grounds of the Imperial Palace? They valued it basically the same as the entire Canadian real estate market or something like that, or stock market.
Yeah, Tokyo, the real estate of Tokyo was worth more, just the city was worth more than the entire real estate market in the United States. And so it was bonkers. That's the thing. It was crazy.
And it's that I think just shows about trying to time bubbles and things when you're in it. I guess so many people would have jumped through and done so many mental gymnastics to say, oh, this is perfectly normal. This is just going to keep going and keep going. On that note, actually, our next question just talks generally about the US. Now, the US has been an exceptional stock market, for a very, very long time. And I guess the question would be, do you think that exceptionalism can continue? And what should people be thinking about? Because like we touched on in the beginning, it's almost like you keep seeing something doing so well that your brain just says, well, it has to stop doing so well soon. It has to crash soon. What would your thoughts around that be?
Yeah, so the U.S. coming out of the Great Financial Crisis was 45% of the global stock market. Today, it's like 65%. So you're right. It's been by far the best performing country really since the 2008 financial crisis, but over the past 10 or 15 years especially. It's interesting to note that, over the last 2 to 3 years, a lot of the foreign markets have started coming back in a big way. And you're seeing things spread out. I think it's the way that I look at it, that technology, especially in like a world of AI, I think really flattens the world. And I think if people assume that all of the good ideas and all the good innovations and all the motivation to improve yourself and have the corporations increase profits and ingenuity and these things that only come from the U.S., I think that's really short-sighted. There's the phrase that winners write the history books, right? Of course, the U.S. has been by far the best performing stock market, and we have some of the biggest and best companies. But I think you're already starting to see it that, with places like Taiwan and South Korea coming up in recent years, where like they're being beneficiaries of the AI trade, and this thing has really gone more global, I think, than anyone. So I am a big proponent of international diversification because the people who worry about a Japan-like situation, if you have all your money in the U.S., I'm not saying we could see another Japan because things would have to get really crazy to get to that point. But you can still have extremes where one country does really poor and other countries do well. That happened, and it wasn't that long ago here.
Yeah, it's a really interesting one because on my own channel, I talk about, I think UK investors and international investors especially will look at, they tackle a big question. Should I just invest in the S&P 500 or should I invest in a global index fund? Now, my personal preference has always been to global. I think going along the lines of what you've said, as the world gets more globalized and it's almost irrelevant where a company is based. Would you kind of agree with that to a certain extent? Like you mentioned, you can have a South Korean or a Taiwanese chip manufacturer be listed in Taiwan Stock Exchange, but ultimately it can sell all around the world. What would be kind of your thoughts on that prospect for investors?
Yeah, I think if you invested your money for the long term in just the S&P 500, you would probably be fine. I think you would probably end up okay. It's the biggest, best companies in the world. But it wasn't that long ago that in the decade of the 2000s, the first decade of this century, the S&P 500 went nowhere for a whole decade. And I think it essentially lost money over 11 or 12 years, right? Nowhere, lost decade. But a bunch of other asset classes did just fine. If you invested in smaller mid-cap U.S. companies, you did much better. If you invested internationally in foreign markets or emerging markets, you did a lot better. And so I think that's the point of diversification. It's not like any days or weeks or months. It's like these really long cycles that you could see these big bouts of underperformance. I think that's where diversification really shines. And I don't know how the future is going to play out. And I think that's one of the, Peter Bernstein, I'm paraphrasing here, said something about how diversification is like admitting your own ignorance about the future. And I don't know if the U.S. is going to continue its dominance like it has. It could just be a way more mature market, and there's other markets that are coming up that could sort of, take some of the share. So I think that's the thing, is like, it's, as a risk management strategy, it not only helps manage risk against those bad times, but I think it casts a wide enough net so you can potentially find the winners that often come from places that are unexpected and you don't know ahead of time.
Yeah, absolutely.
Hit me with some of your least favorite life admin tasks.
I don't do much admin, but the one thing I hate doing, which I have to do regularly, almost every day, is take out the bins. Because I walk down and I'm tall and I somehow manage to bang it on my leg, and then it either explodes or has a hole in it and leaks bin juice all the way down my stairs, or I just hate taking out bins. What about you?
You need some better quality bin bags. And I don't know what being tall has to do with it hitting your legs. So a short person's going to get clapped by the bag just as much.
I think it bounces
obviously
more.
because I'm tall.
Yeah, because I'm tall, it bounces
such
more.
Such an affliction for you. What do I not like doing? Making my bed.
I don't do that.
Changing the sheets. There's a lot of painful admin in life, and it's the same in business too.
In the working world, if the equivalent of taking out the bins is compliance, then having someone do it for you is Vanta.
If you want to sell into larger companies, then you need to prove that you're compliant with security standards like GDPR, HIPAA, ISO 27001, and SOC 2.
To be honest, Damo, it's a pain in the ass. It takes ages, and if I don't do compliance, my deals get blocked. So that's why I like Vanta.
They save you up to 90% of the time it takes to prove you're compliant with these standards, and on average, $500,000. If you know what acronyms like SOC 2 and ISO 27001 are, then you probably need Vanta. You can learn more and book a demo at vanta.com/making money. There's a link in the description, and we've put a QR code on screen for you.
So, in the book, you look at the Great Depression. Do you think that could happen again?
I don't, just because I think the financial markets are so much more important than they were in the past. And I think policymakers have kind of learned. It's interesting. If the Great Depression never happened, a lot of the things that we take for granted today wouldn't be involved, right? A lot of financial regulation came out of the Great Depression, like the SEC and financial regulators. In the US, we didn't have any backstop for people. There was no Social Security. There was no unemployment insurance. It was kind of like, if you got ruined by a financial crisis, you were just ruined. There was no backstop at all. And the Great Depression kind of helped that. And then a crisis like the 2008 financial crisis, where it seemed like the financial system could have really gone under, policymakers looked at the mistakes that they made back then, and they said, we're not going to make those again, because they really did let the economy just, barrel off of a cliff. And so I think we've learned, and you saw how quickly policymakers responded in 2020, right? During COVID, around the world, trillions of dollars were pumped into the economies. People were handed out checks. So I think we've kind of cut that outlier event off. Now the question would be like, what other risks are we creating by doing so? But I think that, I talk about in the book how I think 1% to 2% of households invested in the stock market back then, because most people didn't have enough disposable income to invest.
Yeah.
And so the stock market wasn't nearly as important. If the stock market fell 80% today, there might be rioting in the streets or something. I don't know. It's so much more important to everyone's bottom line that I don't think policymakers would allow it to happen. So maybe I'm wrong, but that's kind of the way that I view it.
Yeah. Yeah, go on.
So I was going to say, do you think because there's so many more people in the market now, if there is a crash, that it's easier to rebound because there's more people who say, oh, it's a discount I can buy in? Do you think it's a bit more robust now with more people in?
I think that could be the case where there's just more households who are tied to it, and people have also studied market history. You see this, you've seen it a lot. I mean, people have been pounded on the head for years and years now of, hey, you don't run out of the store when things go on sale, right? When stocks fall, obviously people are still going to panic, and there's going to be forced sellers. If you took too much leverage and you're going to be a forced seller because you get a margin call, then there's nothing you can do about that. But I do think people have kind of learned their lesson, and we've seen it this decade alone. Anytime stocks have fallen hard, money is rushed in; it hasn't rushed out the door. And so I do think that there is something to this fact that there's just, and especially, there's more retirement account. People in the U.S. used to rely more on pensions, and now it's these automatic retirement savings vehicles. And the fact that people are putting that money in on a regular basis, again, without thinking about it, I do think that's had a really big impact on how the stock market functions. That wasn't like that in the past.
Which then kind of leads me on to another, I guess the question after that is almost like, if we do have some crashes in the future, I know it's impossible to predict, but do we think that they're ever going to be as bad as what they were before? I mean, it's difficult, isn't it? Like the global financial crisis, it's not really going to happen again. That's quite an outlier. Like you said, the Great Depression was a serious outlier. Are we now going to enter the era of super quick dips, super quick market crashes, which very quickly correct? And like you said, policymakers instantly rush to correct things and print money and put rates to zero. What does it mean for the future?
I don't think that we've totally rooted out financial crises situations. There still could be, banking crises or something, if you think about AI, how tied into the economy it is, I think a huge slowdown in AI spending could actually lead to a minor recession. I think that's that wouldn't be like a financial crisis like situation unless things got really bad, I guess. But I think there's also this idea of the wealth effect, where people are more comfortable spending money because their stock portfolio is gone up so much and their house is worth way more. So they kind of go, I don't really need to save as much because I made a bunch of money in the stock market, so I'm just going to keep spending it. So I do think there could be a reverse of that, where if we have a more prolonged downturn and people start losing jobs, I think that's the thing we haven't seen this decade really. And you've seen the reason people have been comfortable rushing back into the stock market is because they still have a job.
Yeah.
Right. So if the unemployment rate in the U.S. has been below 5% for really since the pandemic, that period ended. And so I think if people started losing their jobs and we had a real economic slowdown, I think that's when people might get a little nervous and say, all right, I can't afford to put more money in the stock market.
Yeah.
And only certain people could. And I think that's when and I don't know what the reaction function to that will be, because we haven't really had it in a long time. We haven't really had, I make this point a lot, we haven't had a real recession in the U.S. since 2008. The one in COVID was a month or two long, but it wasn't a real economic cycle. It was, we turned the economies off for a couple months and turned it back on. And so I don't know how people will react because it's been so long.
You said during the briefing call that people see history often as like a checklist. And right now we're in the AI bubble, which is a bit looks similar to the dot-com bubble. What do you think the difference is between the AI bubble and the dot-com bubble?
I think and there are a lot of similarities, right? Of course, anytime a new technological innovation comes along, people get super excited and they extrapolate out in the future, right? And money pours in and you're getting all of that stuff. It's kind of like if it looks like a duck and smells like a duck, quacks like a duck. But I think the biggest difference now is just that these are the biggest, best companies in the world that are doing this, right?
Mm.
And it doesn't mean that they can't make mistakes and they can't go overboard. But in the dot-com bubble, a lot of these companies not only had no profits, they had no revenues. So the fact is that these companies are so, we're talking about these multi-trillion-dollar companies now, right? Nvidia and Microsoft, and they sure can make a misstep, but I think that's the thing that is different, is just that the quality of the companies that are leading the charge are much higher, and these companies are so huge that I think it does kind of make a difference, and there's probably a bigger margin of safety than there was back then.
Yeah, it's an interesting one. It's you talk a lot in the book. It's quite interesting about how the market reacts, and the stock market versus the economy, and what it's like. Even if you knew a recession was coming, if I told you that a recession could happen next year, how would an investor even react to that, or can they even do anything with that information?
It's timing a recession is hard. I think timing the stock market to a recession is even harder, because the stock market is forward-looking. And that's the problem. So I looked at the numbers in my book a little bit. Like if you look at just the actual recession dates themselves, right? Like the actual, like this is what we call the recession started here and it ended here, which we don't really know till after the fact. But these things are dated 6 months later or something. Like when did this, because economic data is hard to find in real time. The stock market during the recession is usually already rising because people have priced it in. The stock market already fell beforehand, and then it started rising. So I think, yeah, you could get the headlines to people. Hey, there's going to be a recession starting June 15th of 2027. I don't think you could go to cash now, but I don't think you know when to get back in, and I certainly don't think you would know when to get out and time it perfectly. That's what makes it hard about recessions. Is it usually it's funny, the stock market and profits tend to bottom before just about everything else, right? The unemployment rate is still rising, and that's what makes it hard as an investor, because people are going, now this doesn't make any sense. This happened during COVID, remember? Like things were getting worse, the case numbers were going up, the economy was getting worse, the unemployment was rising, and the stock market is rising. And people are going, this makes zero sense. And the stock market was trying to look past these things. And that's what happens, and that's what makes it so challenging. Like we talked before about waiting for the dust to settle. Like that's not a coherent strategy, because by the time the dust settles and it's in the headlines, it's already too late, pretty much.
Exactly. I was going to lead that on to, you touched on it recently as well, but we've obviously got a lot of new investors here in the UK and new members of the audience who are starting investing. And again, we've only been shaped by this most recent time period, which have been very favorable. Excluding COVID, which is an extremely short dip, I think the market's averaged like 14% for about a decade or something like that, at least the S&P 500. What would you say to those people who almost now don't believe that the market is going to crash or correct or just continues to go up? Because people, I think, are getting very, very confident.
So I wrote my book kind of for two different people. And one of them was coming out of the 2008 financial crisis. People were like in the fetal position and like, I'm never taking risk again. And now, that was the 2010s. 2020s is a complete opposite. It's, oh my gosh, risk is on all the time. Anytime the market falls, you mentioned it, we have a V-shaped rally. It comes roaring back. Like, why wouldn't I just keep investing? And that, to those people, I wanted to remind them that like risk does exist in the markets. There are going to be bad times, and it's going to happen, and volatility is the price of admission. And so it is a good reminder that you need to be prepared for those times and understand what kind of investor you are. And some people can handle the volatility, right? I think we've seen it with a lot of young people who invested early on in crypto. You've seen like 70 and 80% crashes. And a lot of those people actually held on, and like, great, good for you. Other people just don't have the ability to do that. So I think now is a great time to understand yourself as an investor, because losing money is painful. Like seeing just, if you have this $100,000 portfolio and you wake up in 2 weeks and it's down to $60,000 and you go, oh my gosh, my money just got vaporized. Like that's a really hard thing to do. And, I talk about it in the book a little bit. There's been studies done that people can like relive financial stress in their sleep. Like they have nightmares about losing money. And on the other side, the FOMO you get from missing out on making money. My favorite study on this is from Jason Zweig, who said that the feeling you get, like they've studied brain receptors of people, and the feeling you get from making money in the market is similar to people who are high on cocaine or morphine. Like that's the feeling people get when they have these periods of like, oh my gosh, this is glorious, it's never going to end. But then you need like another hit and another hit. And if it doesn't come, that's the problem. And so I think people just need to prepare themselves for, yes, the good times while they're here, enjoy them, but they do not last forever.
Just talking about that, just try and get people prepared. And I've said a lot, and you just mentioned it there about saying that you need to, find out what kind of investor you are, and trying to stick to a plan. Do you think you can actually do that without experiencing it? Everyone says, I guess it's that famous quote that everyone's got a plan until they get punched in the face. Do you think everyone needs to get punched in the face at some point in their investing career? Because everyone says, "Oh, I'm going to still invest when they have a crash." But I remember, even this wasn't a crash, Ben, obviously, but 2022 was a horrible bear market. Lasted for a long time, and I made lots of videos about it. And I was investing the same every month. But my comment section was filled with people saying, "Oh, it's going to get worse and worse and worse," and "Oh my God, you don't know what's going to happen next." But do you think people need to feel that pain to actually learn a lesson, or because they can look back at all the data like you've done, but
yeah, it's way easier to look back historically and look at a chart and go, I would have bought then, right? So Fred Schwed, who had this really funny book called Where Are the Customer's Yachts? He wrote it in like the 1930s. And he said, there are certain things that cannot be adequately explained to a virgin by words or pictures. And sometimes you have to experience it. I totally agree. Yes, you have to be punched in the mouth. You have to lose money and understand what that feels like. Because again, that losing money, there's this concept I talk about in the book called loss aversion, where losses sting twice as bad as gains feel good. And that's why the emotions are always so heightened during a downturn. And the fact that we haven't had a real big one in a number of years, and there are new investors who haven't experienced one of those, I think that makes it even harder, because you haven't had that experience. You haven't been toughened by it and calloused by it. And it is something that you have to go through that. And I think the experience is something that, it's totally personal.
I definitely agree with you on that one. I mean, for me, I'm definitely someone who needs to learn by experience. My dad's always like, you can do it the easy way or the hard way. I like the hard way. I thought I could stock pick. I burned myself. I thought I could get away with being in trouble at school. I got in trouble. So it's like some of us just need to experience the loss or the pain to be like, okay, I don't want to do this anymore. I never want to feel like that again. Let me try something else. So, yes.
Yeah, and I think that the point I try to make in the book is that there's no one right or wrong way for everyone to invest. The point is you have to find what works for you, and a lot of times find what doesn't work for you. I was the same way. I thought I'm going to be the next Warren Buffett. I'm going to read all the Benjamin Graham books. I'm going to be the greatest stock picker in the world. And I realized immediately, I'm not good at this. I don't have the temperament for it. I don't really want to study the financial statements of these companies and understand them. And it's not for me. Some people are really good at that. I am not. And I think that's what good investing is about, figuring out what you're not good at.
Yeah, I know. You've talked about it a lot, about the fact that investing isn't like an intellectual challenge; it's more about a behavioral one. What do you think? I guess it's probably going to be an easy one to answer. But how much do you think our own decisions affect, compared with what the market actually does, and how much is it on ourselves rather than what happens in the markets?
Well, yeah, the hard part is it's really easy to see problems with other people and biases in other people. But I think the biggest one is everyone has a blind spot to their own biases. And I was asked a couple weeks ago, what's the biggest behavioral bias for all investors? And I said that the biggest one is the one you don't see. Everyone has it. Some people, they're really bad at FOMO, and during a bull market, they get too amped up and they go too crazy, and that hurts them. For other people, they're way too conservative, and they never want to be investing because they're always worried that what's going to come around the next corner is going to get them. And so I think it's really about understanding what is the lesser version of yourself that's going to cause you pain in the markets, and then trying to figure out a way to build a portfolio that can get you through that. Now, there's some people who just need to have a more conservative portfolio because they understand, I can't handle the volatility. I need to be more conservative. So maybe they just need to save and invest more, or they need to, lower their expectations. And so I think really it is about there's no perfect portfolio for everyone. It's the one that you can stick with that will also help you reach your goals.
Do you think over time, especially now, investing's become psychologically harder just because we're so exposed to it? We've got the market in our pockets and the phones. Back when I used to trade, I would wake up in the middle of the night to go to the toilet, look at the price in the charts, wake up in the morning, look at the price in the charts. Do you think that makes it so much harder because it's always inundated into our lives?
Definitely. There's this phrase that all financial advisors tell their clients, and they say, just ignore the noise. And I say that sounds like great advice 30 years ago, because it's impossible to ignore the noise now. You have alerts, you have 24/7, everything. So I think the thing you have to do now is find the right filter. And that includes filtering the sources of your information, like who you're listening to. Because if you want to find someone who is extremely bullish or extremely bearish or likes this stock or hates this stock, you can find it anywhere, because there's so much news and analysis and opinions. And you can find someone who agrees with you. The confirmation bias is so much easier today to find someone who agrees with you or someone who disagrees with you. And yeah, so I think you have to have the right filters in place to guide your actions, because you're right. It's way harder to ignore anything these days. People say like, "Oh, just ignore it. It's fine." You can't these days. You have to figure out a way to filter out, like, you know, does this actually matter to me or not? Like this news, sure, it's exciting, it's interesting, and it's maybe it's moving the market today. Is it going to matter in like a year, 2 years, or 10 years? Probably not.
It's funny, isn't it? I think this problem's going to remain the same and not get any better, unfortunately. Just with 24-hour news media covering markets, and yeah, like I said, I've had at least 10 notifications on my phone to do with markets. But how you react to it, obviously, is the most important thing. Like you said, filters, I think, is a good thing to put in place. Is the whole point of diversification that it should feel uncomfortable? That if your portfolio always feels good, you're probably doing it wrong.
Yeah, I think if you're constantly chasing just the best performers, eventually you're going to end up sad, because nothing works always and forever. And the whole idea that I talk about in the book, and I stole this line from my friend Brian Portnoy, he said, being diversified means always saying you're sorry about something, right? There's something in your portfolio that you go, man, why do I own any of that? Or I wish I owned more of this. And I view diversification as like you're giving up on the ability to hit a home run, but you're avoiding striking out. And I think if you are going to be concentrated in your strategy, I think you just have to have like an iron will and the discipline to stick with it, because you are going to go through a period where you're going to have some really poor performance and something is going to really sting. And I think I don't think a lot of people have the temperament to stick with something when it's not working. It feels great when it is working, right? I'm going to pile into the parts of the market that are only doing good, and I'm going to base my entire investment philosophy off of what's done the best over the last 1, 3, or 5 years or something. That's the kind of strategy that works until it really doesn't work. And I think that's the kind of thing you have to prepare yourself for. And again, I think diversification also is a little bit of an aggressive strategy, because it can help you find areas of the market that are winning that no one expected them to. Right. You know, like I said, these other countries that are doing really well from AI that no one could have possibly predicted in advance.
You spent a long time, spent years working with ballers, incredibly wealthy people. What has surprised you most about what you've learned about what money can do and what money can't do?
So there's this line from a guy named Nick Murray, who's like an advisor to advisors. And he says, if you're still worried, you aren't wealthy. And what I find is that there's still a lot of really wealthy people, objectively wealthy, worth 5, 7, 10, $20 million, who still worry about their money. And you almost have to kind of want to shake them by the shoulders and go, listen, you won. You won the game. It's okay. And the most surprising thing is that there's a lot of wealthy people who will not spend their money. They won't enjoy it. And it's kind of like, what did you did the whole thing where you delayed the gratification, right? You saved and invested for years and years and years. And then it's hard for them to flip the switch and go from saver and frugal person to now I'm going to be a spender. And that was a big surprise to me. I thought, no, it's easy. Once you have money, you spend it. But they don't want to see the number go down. Like the number is like a status symbol for them. It's not like cars and houses. Like that stuff is great. But for some people, I can't see my portfolio go down below this level.
Yeah.
And it's like, well, why not? Isn't that the point of it? You save the money, so so they want to like live off the interest and never touch the principal. And it's interesting to see that the worries definitely change when you have a lot of money. Like you're way more comfortable, obviously. The little things don't bother you as much anymore. But the big thing is that it's still not like it just relieves all stress in your life.
Yeah.
It changes shapes.
Leading on from that, has that affected the way you look at money in your own investments? Like, a number, a goal, a target, or does that change the way you think about things?
It has. And I think it's made me realize, like, you should, and I've seen these other stories where people toil away and save and they build a business for 30 years. We had one guy who built a business and sold it for 9 figures. And literally a week after he sold his business, signed the paperwork, he dropped dead. And that's not the first story that I've seen like that, where someone spends their whole life and then their health goes. And so I think it's opened my eyes to the fact that I need to have more balance, and I can't just be saving and putting away every single penny because it's going to compound in 30 years to this. Like you have to enjoy some of your time now as well, especially while you have the time and you have the health.
Yeah, absolutely. You've probably read Bill Perkins' book, Die with Zero.
Yep.
Do you share that rough philosophy then, trying to make the most of the health you have now and spending that money on experiences, and rather than saving this magic amount of money for a time that may not be around?
I like his idea. I don't agree with everything he says.
Yeah.
The message definitely resonated with me when I
Yeah.
read it, though. And I think a lot of people who are wealthy need to hear that message. And I love his idea that he says, like, your net worth should peak in your 50s.
Mm-hmm.
And for some people, that's like, oh my gosh, no way. It has to peak the day I retire. It has to be the highest level ever, and it can never go down. And so I do think a lot of his stuff that he says really, and his whole point is, yeah, like, do the big thing while you can still enjoy it. Don't wait till you're 80 years old and your body gives out and you can't, enjoy your time anymore.
Yeah, 100%.
Why do you think humans are so bad at realizing when we have enough?
I think it's honestly one of the great things for us as a species and a terrible thing for us as an individual, because as a species, it kind of keeps us going, right? The goalposts are always moving. If I just make this much money, I'll be happy. If my portfolio hits this level, I'll be happy. And then you get there and realize, like, oh no, nothing changed. Now the number just goes up. And I think as a species, it's good for us because no one is ever really content, right? And we're constantly pushing forward and trying new things. And you see this with all the really, really wealthy people. It's like, why are you not just on an island somewhere, sipping Mai Tais with an umbrella in your drink? Instead, you're building more businesses. And so I think for us as a species, it pushes us forward. As an individual household level, it probably makes way too many of us miserable because we can't find content. And I always tell people, like, don't worry about finding happiness. Worry about just being content with what you have and being grateful. And I think the way that I've always tried to do this is comparing myself to my previous self, not other people, right? Like 10 years ago, did I think I'd be in this position, that I have this much money, or that I'd be doing this? And when I first started my career, did I think I'd be in this place? And those kind of things, like, you look at yourself and your own mile markers and go, oh yeah, that's right. I think that's a good way to stay grounded and grateful.
Yeah. We always tend to forget our goals and when we achieve them. But yeah, that's a great point. I've got a selfish one. I'm a little bit selfish. I mean, it's my podcast. I can be selfish. I've got a 3-year-old son. And I mean, I guess if you could tell, do you have children?
Yes, I have 3 children, a little older than you. I got twins that are 9 and a 12-year-old daughter is my oldest.
Wow. If you could tell your children one piece of advice, financial advice, what would it be?
Ooh, that's a great one. It's funny. My biggest one is always, my number one personal finance advice is just never hold a credit card balance. That's like an easy one. Like, never pay it off your credit card every month. That's the one that my dad instilled in me. It's like the only piece of financial advice my dad ever gave me. He said, just don't ever let your credit card balance roll over from one month to the next. Just pay it off every month. And that's like his number one personal finance goal. I guess what I would tell them is, especially when you're young, it helps. Personal finance is so much more important than so many other topics. And I think just understanding the ideas behind saving and investing and budgeting and understanding your money and where it goes. I think a lot of people don't understand that stuff until it's too late. And I think understanding that from a young age is really helpful. I will try to get that. I will try to instill those values in them. We'll see if they listen to me. I can't promise that they'll listen.
When's a good time to start? What's a good age? It's 3 too early, because I've been trying to get him into investing, and he's like, Dad, I want to watch Peppa Pig and like Paw Patrol. What are you talking about?
Yeah, I tried to do like I'm the bank, and hey, if you guys put money into your investment accounts that I set up for you, I'll match your money or something. And they don't care yet. So I'm going to have to wait till they're teenagers probably.
It's a difficult one.
Thanks.
And then just kind of on a general question, I mean, we talked about a lot about recessions and crashes and all these things, but after everything you've learned about the markets and research, would you say you're more optimistic today than you have been?
It's interesting. I heard this interview last week with a historian who said that studying history has to make you optimistic, because if you study history, you understand all these stupid mistakes that we've made. There's so many mistakes and things that we've done wrong, and we've still come out okay, right? And that's the point. Like, we're going to make mistakes. Things are going to go wrong. And yeah, I'm naturally, I think, a glass is half full optimistic person. I think if you're not at least a little optimistic, you have to be kind of optimistic to invest for the future. Like, if you're not optimistic that tomorrow is going to be better than today, or 30 years is going to be better than today, like, why are you investing in the first place? What's the point? So yes, I do think that studying history is a good way to understand that, man, we've been through a lot. Like, there's a lot of bad stuff that has happened, way worse than today. And we've made it through. And I think that's like the power of the human spirit. And we've been through a lot just this decade alone, with the pandemic and everything that's happened, and inflation and all these things. Like, it's been a really crazy decade, and we've come out okay so far.
Yeah. Just got to have that long-term mentality and stop thinking short-term. But we're still trying to work on that from us in the UK. But
it's hard.
Yeah. Thanks, Ben. Thanks so much
Really
for
appreciate
your
it.
time.
No, this was great. You guys didn't even buzz me once, so I appreciate it.
That's all good. Thank you. Yeah, the book's great. Obviously, I love your blog anyway. So keep fighting the good fight.
Thanks, guys.
Awesome.
You're the man. Thanks.
Thank you so much.
So Toby, we had Ben in the building. Well, on the
We
Zoom.
did. We had him on screen. Yeah, it was
What do you
really
think?
interesting to talk to Ben because I've actually followed his blog for quite a long time and actually used a lot of his research in my videos and read his recent book. So it was really interesting to get his insight. The guy's so knowledgeable, all the previous crashes we've had, and so much knowledge and advice to come from him. So it's well worth watching that episode.
Yeah, and I will not try to time the market. But if you like that, Ben, we've got another Ben for you. Ben Felix, he came on the podcast. He also owns the Rational Reminder podcast out in Canada. Great episode. Check it out here, or maybe link in the description. Who knows? But it's here somewhere, so you'll find it. I promise.
Somewhere.